Can IRA funds be used to purchase real estate? Great question. Today, we'll be uncovering the secret behind using your IRA to purchase real estate. Not only is it possible, it can also be one of the most effective ways to invest. Stick around to find out why and how you can make it happen for yourself. In this video, we'll reveal 3 ways real estate can help anyone build an incredible nest egg, potential pitfalls to avoid, you'll learn how the best real estate investors boost their retirement with real estate, and finally, you can turn what you've learned today into actionable steps towards maximizing your retirement. So let's dive right in. If you've been following us over the years, you've probably already heard me say a little bit about what we're getting into here, but it bears repeating in this context. The benefits of using your IRA to purchase real estate are numerous. For starters, real estate can provide higher risk-adjusted returns compared to traditional investments like stocks and bonds. As I'm sure you know by now, real estate investments, they generate passive income through rent, which can help you exponentially grow your retirement savings over time. Additionally, one of the most attractive benefits of real estate investing is diversification, which is crucial when it comes to developing a well-rounded investment portfolio. By adding real estate to your investments, you're essentially spreading your risk across different asset classes, reducing the impact of market fluctuations on your overall returns. Another major advantage is tax-deferred growth. With a traditional IRA, your earnings grow tax-deferred, delaying the payment of taxes on your investment gains, allowing your investments to compound without being hindered by taxes until you actually withdraw the funds. Folks investing with their IRA will often strategically plan to withdraw those funds during retirement, providing them with consistent cash flow to fund their lifestyle needs. Lastly, real estate can serve as a really good hedge against inflation. As property values and rent typically increase over time, it'll help you protect your retirement savings from the eroding effects of inflation. As promised, we're going to talk about some of the pitfalls that you want to look out for in the form of self-directed IRA rules and limitations. It's crucial for you to be aware of the fact that your IRA, it owns the real estate, not you personally. And this is investing into your retirement in the truest sense of the phrase. What this means in a nutshell is that all the expenses related to the property, such as maintenance, taxes, capital expenditures, all the expenses, they must be paid by your IRA. Additionally, all income that's generated, whether it's rent or whether it's from the equity buildup over time, cash out refinances, ultimate disposition proceeds, all that must be deposited back into the IRA account. Can't go directly to you. Additionally, you can't use the property for personal use or benefit. That means you can't live in the property. You can't rent it to a disqualified person or use it on personal vacations. In an active investing scenario, these limitations, they remove some of the major benefits of property ownership, which makes passive investing in your IRA into real estate all the more attractive. Prohibited transactions or actions that are prohibited by the IRS in connection with the IRA account. These are actions that can lead to significant penalties or even the disqualification of your IRA, so you got to be very careful with this. Some examples of prohibited transactions include selling property to your IRA. You can't sell property to your IRA, right? Property that you already own, you can't sell that to your IRA, nor can your spouse, your children, your parents, or any other disqualified persons, as defined by the IRS. You also can't buy property from your IRA, nor can you use IRA assets for personal benefit. You also can't borrow money from your IRA. And last but not least, you can't use your IRA as collateral for a loan. To avoid prohibited transactions, it's imperative that you ensure that you're dealing at an arm's length with all the different parties involved in the transactions that are related to your IRA-owned property. It's also important to bring in an attorney, bring in all the different folks that are necessary counsel-wise, financial advisors, attorney, etc., to ensure that you are navigating all these various pitfalls prudently. There's many different I's that you should dot, T's that you should cross, and you should have counsel on your side to make sure you're doing everything appropriately. Disqualified persons are individuals or entities with whom you can't conduct transactions through your IRA. They include you, your spouse, your children, and their spouses, and any of the businesses that you can control. Transactions between your IRA and disqualified persons can result in significant penalties and tax consequences. To avoid complications, as mentioned, always ensure that your IRA deals only with unrelated third parties. What about UBIT? You may have heard this when you're looking to potentially invest in real estate through a self-directed IRA. Unrelated business taxable income, or UBIT, it's another important concept to understand. This tax applies to income that's generated from debt-financed property inside of your IRA. For example, if you use a mortgage to finance the purchase of a rental property within your IRA, a portion of that rental income, it might be subject to UBIT. To minimize or avoid UBIT, consider purchasing properties outright with your IRA funds instead of using debt financing. Alternatively, depending on the fund structure, you can invest in a private real estate fund or other indirect investment vehicles that are not subject to UBIT, such as a REIT. Make sure you consult a tax professional to ensure that you comply with UBIT regulations and understand the potential tax implications of your IRA-funded investments. Before we continue, if you're finding this information valuable and you want to learn more ways you can maximize your portfolio with the power of real estate, make sure you hit the subscribe button for plenty of more tips where these came from. Now that you understand the rules, let's discuss how to purchase real estate with IRA funds. First, you'll need to set up a self-directed IRA with a custodian who allows real estate investments. Once it's set up, you can transfer your funds from your current IRA to a new self-directed IRA. When you've identified a property that you want to invest in, instruct your custodian to purchase the property on behalf of your IRA. Remember, the property title should be in the name of the IRA, not in your personal name. It's essential to work with a team of professionals, including a real estate agent, attorney, tax advisor, to ensure that the entire process is smooth and compliant with all the regulations. Setting up a self-directed IRA is relatively simple. Choose a reputable custodian that specializes in self-directed IRAs and offers real estate investment options. There's plenty of them out there. Some are larger, more established, oftentimes have a little bit more fees. Some are smaller, maybe more white glove service, but don't have as much administrative help on the team to maybe help you in these unique ad hoc scenarios. Simply reach out to them, get the feel of after vetting a litany of them, figure out which one you feel is best, and ultimately complete their required paperwork, which typically includes an application form and a transfer or rollover request from your existing IRA or from 401k funds. Once you have established your self-directed IRA and the funds have been transferred, you can then begin searching for suitable real estate investment opportunities for you and your family. As you're vetting the different real estate investment opportunities, you should be considering factors like location, potential returns, and overall market conditions. Look for properties with a strong rental history, low market vacancy rates, and the potential for outsized appreciation over time. Collaborate with a real estate professional who is familiar with the local market and can help you find suitable investment properties. They can also assist with property management, which is also crucial for maintaining the value of your investment over the long term and ensuring compliance with IRA regulations. As you're underwriting and analyzing properties, don't forget to factor in expenses like property taxes, insurance, maintenance, property management fees, and the like. These costs are going to need to be paid from your IRA account as opposed to you personally. So make sure that your IRA has enough funds to cover these additional ongoing expenses. Our favorite shortcut when using your IRA to invest is, of course, investing in a private real estate fund. Working with a private real estate fund can be advantageous when you're using your IRA to invest for several different reasons. You get diversification. Private real estate funds invest in multiple properties, providing investors with diversification across various different assets, various different geographic regions, and different types of real estate. This diversification can help reduce risk and enhance the potential for outsized risk-adjusted returns. You get professional management. Real estate funds are typically managed by experienced real estate professionals who have a strong track record in sourcing, purchasing, managing, and disposing of real estate assets. They are responsible for all aspects of the investment, including property management, leasing, maintenance, and ultimately selling the deal. This can be particularly beneficial for IRA investors who may not have the expertise or the time to manage real estate investments themselves. You can reduce your risk through this platform. Private real estate funds invest in a range of properties, spreading your risk across multiple different assets. Additionally, real estate funds often have multiple different investors, which helps reduce the impact of any single investor's actions or decisions on the fund's performance. Private real estate funds can provide attractive risk-adjusted returns to investors due to their access to off-market deals, ability to negotiate favorable terms, and the potential for value-add opportunities over time. You get access to deals that you otherwise wouldn't be able to do personally. Investing in a private real estate fund can provide you with access to real estate opportunities that may not be available to individual investors, such as large commercial properties or development projects. We own multiple deals in the heart of downtown environments in various different MSAs throughout the country that would be unlikely for one individual investor to acquire. Professional management and access are two massive pieces that a lot of investors just don't consider until they're up to their eyeballs in analyzing less than stellar deals. And once they finally find that one individual gem, that hidden, diamond in the rough, if you will, unfortunately sometimes it slips through their fingers at the very last minute. And even if they acquire it, they're stuck managing a litany of things that they would not otherwise want to do. And that wraps up today's episode. As a special special bonus, guys, we have a free gift for you in the video description. It's our comprehensive guide to passive investing in mobile home parks. It's our favorite asset class in all of real estate. To get your hands on this invaluable resource, click the link in the description below. Thanks for joining us, guys, and don't forget to subscribe for more real estate investing tips. We'll see you soon.